Hey there, Brad Castro from GreatOptionTradingStrategies.com. We've all had that moment. Maybe it was live, maybe it was on television, but at some point we've all watched a magician or escape artist do something so impossible, so completely beyond explanation, that it felt like the laws of physics had been temporarily suspended right in front of us. Chains, locks, sealed boxes, impossible traps, and somehow he gets out. And we're left staring at the stage, shaking our heads and asking the same question everyone else is asking. How the hell did he do that? Well, in today's video, I'm going to walk you through a recent covered call trade repair on HIMS. A trade that didn't just go against us, it completely fell apart. And from the outside, you might look at the final result and swear we somehow bent the laws of mathematics and finance. But I assure you, there was no trick, no illusion, and no sleight of hand, just a very specific trade repair process. And best of all, I'm going to show you exactly how we took what could have been a disastrous, maybe even catastrophic trade, and turned it into one that still produced some pretty damn good returns. Specifically, here's what we'll cover in today's video. Part 1, what we wanted and expected to happen with the trade and why. Part 2, what actually happened. Spoiler alert, it couldn't have been a worse outcome. And Part 3, how we still made really good returns. This is the magic trick part, and also where I explain exactly how we made our Houdini escape and got paid really handsomely in the process. Now, before we get into the actual trade repair, I just want to let you know that I've also added some links in the description to a few other videos that go into more detail on some of the concepts we'll be talking about today. Nothing here should be especially confusing, but sometimes with options, it helps to see the same idea explained a couple of different ways before it really sinks in. Believe me, I've been there. When I was first starting out with options 25 years ago, there were plenty of things that I had to learn several times before I finally truly understood them, and even longer before they became second nature. Part 1, what we wanted to happen and why. So I've been watching HIMS for a while back at the end of December 2025 and the beginning of January 2026, and liked what I saw when the stock bounced off a key support area in the 32 to 32.50 area, as you can see in this chart. And I made it an official covered call for income trade inside the Leveraged Investing Club. So we set it up as an in-the-money, buy-right covered call, meaning we simultaneously bought the shares and then sold or wrote a covered call at a strike price below the current share price. More specifically, we went with a $30 strike or the lower end of where we identified support and where the stock had just bounced. So let's go over the details of the trade entry and then look at why we set it up this way and what we wanted and expected to happen. So on January 5th, 2026, we bought 100 shares of HIMS at $34.81 a share. And then at the same time, we sold to open a HIMS February 20th, 2026 $30 covered call for $6.16 a contract. After commissions and fees and netting out the assumed assignment at the $30 strike price, I collected $133.80 in time value net premium for a very strong 35.39% annualized rate projected over the following 46 days until expiration. Okay, let's stop right there and go over the math because it's probably not going to be super obvious, and it's important we're all on the same page here to understand the objectives and return potential with the trade. So we bought 100 shares of HIMS for $34.81 a share, and at the same time sold someone else the right to buy those shares from us for $30 a share. And if someone took us up on that offer, we'd lose $4.81 a share in terms of the value of the stock. We buy shares at $34.81 and sell them for $30. But we also sold the covered call in question for $6.16 a contract, well above the $4.81 a share anticipated loss on the shares. So on a net basis, backing out the $4.81 expected loss from the $6.16 in premium collected, that's a net positive $1.35 per contract, or after commissions and fees, $133.80. 135 of the 616 we sold in the covered call is the call's extrinsic or time value, meaning the remaining 481 of premium we collected was intrinsic value, or how much in the money or below the current share price the covered call was when we entered the trade. And that lines up perfectly with our anticipated 481 a share we expected to lose if our shares were called away. Now, I refer to this structure, selling in the money covered calls, as a covered call for income trade. When we sell or write in the money covered calls, we're only focused on isolating the time value portion of an option and securing it as income. We're trying to remove the impact of the movement in the underlying share price from our final returns. So the ideal outcome is for our shares to be called away from us, to lose that $4.81 a share in the stock, but in the process walk away with those $1.35 per contract net time value gains. Or as I say, the trade is designed to be assigned. So we really wouldn't care whether the stock was trading at $31 a share at expiration or $51 a share at expiration. As long as it's trading above that $30 strike price at expiration, our final gains would be the same $1.35 of net premium or time value that we collected, or again, $133.80 after commissions and fees. Now, there's actually a much simpler way we could have structured the trade to achieve the same outcome and essentially the same returns. And that's to have sold or written a cash secured put at the same $30 strike price and the same February 20th expiration date. So let's walk through that real quick. Under the same scenario with HIMS trading at $34.81, we also could have written or sold a HIMS February 20th, 2026 $30 put for somewhere around $1.35 per contract, or the same amount of time value that was in the $30 covered call when we sold or wrote that. With the stock at $34.81, there was zero intrinsic value in the out-of-the-money $30 short put. By definition, 100% of the premium available would be extrinsic value or time value. Now, I go over this in more detail in some of the other covered call videos I've put together, and I've added links to those in the description. But if we're talking about the same strike price and the same expiration date, an in-the-money covered call is equivalent to an out-of-the-money short put. Yes, there are going to be some pricing differences depending on a stock's dividend calendar, in this case not a factor since HIMS doesn't pay a dividend, and depending on the current interest rate environment. Now, I didn't note or record the pricing on the corresponding $30 puts at the time I entered the covered call, but I can promise you it would have been in the ballpark of that $1.35 area. Probably a bit lower as the interest rate factor, or rho in the option Greeks, currently boosts call pricing a bit over put pricing. So I think it's much easier to understand the objectives of the covered call for income trade we entered and the math if you look at it from the hypothetical short or naked put angle. Again, with HIMS trading at $34.81, an income-focused put seller could have sold a February 20th $30 put for somewhere around $1.35 a contract, and the ideal outcome would have been for the stock to remain trading above that $30 level so that the put either expires worthless or so that it could be bought back on the cheap at some point ahead of expiration. And again, that's equivalent to the call being exercised against the covered call writer and having his or her shares called away, or the whole position being manually unwound at some point ahead of expiration if it can be done so cheaply and makes sense on a final annualized ROI basis. So having said all that, that begs the question, why the hell did we structure the trade as a covered call if setting the trade up as a short put position was so much simpler and easier to understand? Well, I think it's a good idea to have experience using both structures to trade these trades. That way it goes beyond just abstract knowledge and becomes actual experience that you internalize. The more you internalize option selling from all different angles, the more patterns you begin to recognize and insights you gain. So we actually set up a number of our sleep at night trades as buy right in the money covered calls instead of naked or short puts inside the leveraged investing club, so that club members, and myself as well, can gain more experience with the covered call version of the trade. And it's also important if you're primarily a covered call writer to really understand that in the money covered call writing is a viable, even preferable in my view, income strategy, and one that's a whole lot safer than writing or selling covered calls out of the money, because your break-even or cost basis and your downside buffer is so much better. And again, check out the links in the description section for other covered call videos that go into these issues more deeply. Part 2, what actually happened? Okay, buckle up, because we're about to go over Niagara Falls on this one. So as you can see in the chart here, the stock had steadily been drifting lower toward that $30 share price level where we had our covered call. And then it dipped below $30, continued trading lower, and then the sell-off accelerated, and then the stock gapped lower, below $20 a share, and continued drifting lower some more, down into the mid-teens. At its low point, the stock traded all the way down to around $14 a share. That was about a 60% crash based on where the stock had been trading when we entered the trade a few weeks earlier. Holy moly. Now for some context, not that it really matters when it comes to the actual trade repair, this huge sell-off was related to the controversy and legal pushback that the company experienced after announcing a cheap knockoff version of Novo Nordisk's weight loss drug. It was looking more and more like they were in deep doo-doo legally, both from Novo Nordisk and probably also from the FDA. Now that would eventually get resolved, and it was all likely a high-stakes gamble, and Novo and HIMS hammered together a settlement where they would actually work together, and the stock would rebound, but only partially. Or rather, shares did eventually recover enough, weeks and months later, to briefly, very briefly toy again with our original $30 strike area. Although as I'm putting all this together 5 months after our original trade entry price, the stock is now just getting above $30 a share. But the reason I'm pointing all this out is that yes, the stock did partially rebound, But that's not why we were able to repair the trade and walk away with still very, very good returns. Because per the trade repair moves we're going to go over, we never needed the stock to do any of what it did. We didn't need it to get back to our original $34.81 entry trade price. We didn't need it to get back to our original $30 strike price. We didn't even need it to get back to the mid-20s level where it was trading 5 months later. We just needed it to be trading at or above $18 a share. Seriously. Part 3. How we still made really good returns. So, how did we take a stock that sold off 60% on us and turn our covered call trade around so that it actually produced 18.15% annualized positive returns? Well, I'll show you step by step what we did. But before we get in that, just take a moment to really let that sink in. We entered the trade when HIMS was trading at $34.81 a share, and it traded all the way down to $13.74 on an intraday basis on February 24th. That's a 60.53% sell-off. And we not only survived the trade, we actually made very good returns. Okay, the best way to walk you through this is to, once again, consider the put-selling version of the trade. When we sell puts on a stock and the trade goes against us so that the stock trades below the strike price of our short puts, our primary objective is to roll our short puts down and out to a lower strike price for a net credit, as long as we don't have to roll out farther than 3 monthly expiration cycles. And just to make sure we're on the same page, a net credit simply means you collect more money when selling or setting up the new position than what it costs you to buy back or exit the old position. And if we can't swing that because the stock has moved against us too much, then we'll just roll straight out to the same strike price for a net credit. Again, not going out more than 3 monthly expiration cycles. But sometimes, and this was definitely one of those times, the stock moves against us so much that even rolling straight out only produces a meager net credit. That's when we bring out the big guns. This is when we'll expand the trade as a way to work the strike price dramatically lower. Outside the leveraged investing club, I call it the double half principle. Inside the club, we call it stage 3. By doubling the number of contracts, we can effectively cut in half the distance between the current strike price and the current share price. For example, a $100 short put on a stock currently trading at $70 a share is $30 a contract in the money, or said another way, it has $30 of intrinsic value. Well, you know what else has $30 of intrinsic value? 2 short puts at the $85 strike price. Doubling the number of contracts to work the strike price lower is a very powerful move. But you don't want to fall in love with it, because if you immediately start expanding trades that move against you, you're going to be over leveraged in no time at all. For the same reason, we're pretty disciplined when it comes to our opening position sizes, which we keep relatively small. And again, we only expand a trade when we absolutely have to. But with the HIMS trade, we definitely needed to. So what would the double half / stage 3 repair move look like from the covered call version of the trade? Well, it's very simple. Instead of adding a second short put contract, we would simply buy another 100 shares on the open market and then sell 2 covered calls at a much lower strike price. So for instance, with our $30 covered call example, if the stock was trading exactly at $20 a share, we could buy 100 additional shares at $20 a share and then sell 2 $25 covered calls. Now with HIMS, we actually did something different, something we've never actually done before with an official club trade. We did a double stage 3, meaning we didn't just double the number of covered calls by buying an extra 100 shares and then selling 2 covered calls at a much lower strike price. We quadrupled the number of covered calls by buying 300 shares and then selling 4 covered calls at a much, much lower strike price. We did that for a number of reasons. The stock was deeply oversold, premium levels were crazy high, partly because of the fear and volatility of the stock, and partly because of the upcoming earnings release. And when I ran the numbers, I realized I could convert a single February 20th, 2026 $30 covered call into 4 March 20th, 2026 $18 covered calls, and also bring in a ton of new net premium. So let's walk through that so you can see the numbers. So on February 9th, I bought 300 shares of HIMS at $17.11 a share. That completely changed our true exit strike price from $30 a share to $20.33 a share. And I get that from the $3,000 capital requirement implied by our $30 covered call strike price, plus $5,133.84 of new capital buying those 300 shares, and you add that together to get $8,133.84 divided by now 400 shares, and that works out to $20.33 a share. So then I bought to close the single HIMS February 20th, 2026 $30 covered call for 4 cents a contract, and I sold to open 4 HIMS March 20th, 2026 $18 covered calls for $2.45 a contract. And the stock had actually risen a bit to $17.48 a share when I sold those new $18 covered calls. So that move added $971.37 of new net premium that day, bringing our accumulated net premium collected to date to $1,105.17 a share. And while we don't manage a trade by break-even or cost basis, it can be a good way to keep score. And this move worked our break-even or cost basis down all the way down to $17.57 a share. Now, this was a bit of a risky move to the upside if the stock rebounded strongly at some point and I was forced out of that $18 strike price. Because what I'm calling my true entry strike price here was $20.33 a share. So in that scenario, we'd have to give back $2.33 a share in capital losses, or $932 of the total net premium we'd accumulated over the first 2 legs of the trade. But I felt it was worth the risk to aggressively work the strike price and break even / cost basis lower. And even if I had been forced out, the trade would still have been respectfully profitable at a 14.97% annualized rate. Okay, so HIMS did recover and even traded back above $20 a share on news that they and Novo had settled their differences and would now be working together. And at this point, I could have easily exited the trade by allowing my 4 covered calls to be assigned and all my shares called away. And if the trade had ended there, as I said, this still would have been a very successful trade and an amazing trade repair. But I really wanted to squeeze more out of the trade, given that it was pretty clear that the worst was over, and also that the stock was now $5 a share above the strike price of my covered calls. But I also wanted to dial back some of the risk just in case I was wrong. Now, this move was only possible because HIMS premium levels were still very elevated. So what I ended up doing was rolling 2 of the March 18 covered calls out to the April cycle for a very nice credit, and then simply allowed the remaining 2 March covered calls to be assigned and to have those shares called away from me. So on March 13th, I bought to close 2 of the March 20th, 2026 $18 covered calls for $5.66 a contract, and sold to open 2 April 17th, 2026 $18 covered calls for $6.21 a contract, or a 55 cents per contract net credit, or $107.52 of additional net premium after commissions and fees, for a really nice 27.57% annualized rate on that leg of the trade. I love this move because it brought in more net premium at a great annualized rate, and while it wouldn't reduce how much I would have to give back to Mr. Market if and when all my shares had been called away, it did boost the final annualized returns pretty nicely from 14.97% to 18.15%. And it also cut the number of contracts back down to 2. Now, I could have maintained the number of contracts and focused on working those to higher strikes and potentially capture more gains that way. But I much preferred reducing the position size and keeping what remained at that lower and safer strike price while still boosting my overall returns. As a reminder, the trade began with a single $30 covered call contract, and it would end with 2 $18 covered calls, which, because of the dramatically lower strike price at the end, was pretty close to the trade's original size in terms of capital requirements. Now, as we approach the April expiration, depending on where the stock was trading, I did consider rolling and reducing the position one more time, meaning I would allow 1 covered call to be exercised against me and roll the final remaining covered call out 1 more month. That would have completely reset the position size back to a single contract, although on a capital basis, the position would only require $1,800 to secure versus the original $3,000, thanks to how much we lower the strike price over the course of the campaign. But it would only make sense to continue the trade through the upcoming earnings release if the net premium collected on the next roll was at a high enough rate that we could continue accelerating the overall returns. But at that point, with HIMS continuing to trade higher, the $18 covered calls were deep enough in the money that the annualized rate on the net premium available on a roll to May just wasn't enticing enough to make me want to continue. So I simply allowed my shares to be called away from me at expiration and locked in the campaign's final returns, which worked out to be 18.15% annualized over 102 days, which would have been very hard to believe 2.5 months earlier. And to confirm, as you can see here, the final results did reflect the capital losses from selling shares below the average assigned and purchase prices of the stock. Okay, there you go. This was not magic. It was a combination of math and psychology. The math part is actually pretty simple and just involves using future time value and sometimes in extreme cases, a little extra capital to steadily work the strike price lower in a trade that goes against you, and also collecting more net premium every time you touch a trade. Again, really let that sink in. Unless a stock never stops trading lower or falls to zero, and assuming you haven't self-sabotaged by over-leveraging from the beginning or sold puts or covered calls for income at technically overbought tops, actually booking the loss at the end of the day is pretty much unnecessary and totally avoidable. So that's the math part. And I really believe this, but to me, the stock market is only 25% about math and 75% about psychology. And the math here is simple. Roll down and out to lower strikes for net credits when you can. Roll straight out for net credits when you can't roll down and out. And when necessary, add contracts to really work the strike price lower while, you guessed it, bringing in more net premium. The more you work the strike price lower, the quicker you'll be out of the trade. And the more net premium you accumulate over the life of the campaign, the greater your final profits will be. And if you really think about what it requires for even a single double half or stage 3 trade expansion to be triggered, you can kind of project how much of a sell-off in the underlying stock that even doing 2 to 3 of these moves would require. It depends on the implied volatility levels involved, but 2 of these moves would generally require at least a 40 to 50% drawdown, and 3 of these moves you're most likely looking at a 60 to 70% or greater sell-off. And that's extremely rare. And at that point, we still have our stage 4 repair move, which involves incorporating selling offsetting options on the other side of the trade. But big picture, if you enter every position at a size where you would be comfortable doubling the number of contracts a couple of times, and again, because you're working the strike price a lot lower when doing this, doubling the number of contracts does not double the amount of your capital requirements. So there's no need to stress or freak out. And historically, in my experience with trades inside the Leveraged Investing Club, only about 5% of our trades ever require additional capital. And most of those times, it's just a single trade expansion incident. But still, we size our opening positions as though every trade will eventually require more capital. So that's the psychology part, which is remembering the straightforward math and keeping your emotions in check. And also remembering that the stock market is primarily sentiment driven. And that can turn on a dime. So a healthy skepticism of what the stock market is doing at any point in time is your best friend. The stock market is not some all-wise, efficient pricing mechanism. It's fear, greed, and groupthink. And that's why I love selling options and selling premium. Because while I do my best to find high probability trades, I never have to be right to still make money. And I know I'm going to be wrong plenty of the time. And as you can probably surmise after the HIMS trade, making money from so-called bad trades is the norm for us. It's not the exception. I've added links in the description, but in 2025, all 46 club trades we closed were profitable. And so far in 2026, we're 23 for 23. And only 5 of those trades over the last year and a half resulted in single-digit annualized returns. The rest, 92.75% of them, generated either double-digit or triple-digit annualized returns. And get this, 11 of those trades we closed for triple-digit annualized returns, or roughly 15% of all the trades we've closed in the last year and a half. Now, granted, our triple-digit annualized gainers aren't going to be trade repair situations. They're trades that totally went our way early on and we were able to exit way ahead of schedule. So the annualized numbers are skewed some by the abbreviated holding period. But the point of all this is, heads we win, tails Mr. Market loses. It's not magic and it's not an illusion. It's just a trading approach with huge structural advantages if you know where to see them and how to exploit them. Okay, if any of this resonates with you, if you're tired of taking unnecessary losses, if you find yourself in underwater trades and don't know what to do, if you're tired of being at the whim of Mr. Market, which is all the maniacs in the market who aren't you, I encourage you to check out all the resources I put together for you. I've been actively adding new YouTube content over the last year, and I have a ton of option selling resources for put sellers and covered call writers in the description section. From ebooks and strategy guides and case studies to a spam-free daily option tips and insights newsletter. And if you'd like me to take a look at any of your current trades that may be misbehaving on you, I'd be happy to check them out and share my insights and give you some choices to consider. But that's a free service I only offer to readers of the Daily Tips newsletter. So be sure you're signed up for that. which you can do directly or by downloading any of the free reports or other resources on the Great Option Trading Strategies downloadable library page. Again, all those links are in the description section. Okay, until next time.